Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to discuss 3 of the top specialty REITs on the market right now. Real estate investment trusts, or REITs, offer investors exposure to various types of real estate that most people could not buy on their own. These typically include office buildings, shopping malls, or industrial warehouses. But in this episode, we're going to discuss 3 companies that are considered specialty REITs. They don't own the traditional apartment-style real estate, they have unique operations, and they all serve a growing industry. So for each company, we're going to take a look at how they operate, what type of buildings they own, as well as the historical and future growth of the company. But before we take a look at that first stock, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos, and the first REIT we're going to go over in this episode is ticker AMT, which is American Tower Corporation. They currently trade for $244 per share, somewhat flat over the past 12 months, only growing by 3.4%, and they have a market cap at $110 billion with a current dividend yield of 2%. So this is one of the largest cell tower / communication REITs in the industry right now. And AMT provides the necessary real estate for the world's growing wireless communication networks. And we have an example of what a typical AMT site would look like. The actual REIT maintains the location and the property as well as the steel structure of the tower. Meanwhile, the tenant or the person paying rent operates the antennas and all the equipment surrounding each individual tower, and it can be suited to the tenant's individual needs. So right now, as the company continues to expand locations, it will grow their revenue, but they also have plans to monetize even more with their existing towers. And their goal is to add more tenants to their existing structures. So we can see right now, they have a lot of traditional one-tenant units. But going forward, if they can add 2 or 3 satellites to the same structure, it will add additional revenue while keeping costs relatively stable. So I think this plan for expansion and growing, not only with new locations, but adding revenue to their existing, is going to lead to great long-term success for AMT down the road. And right now, at this $244 level, the company is estimated to be close to 20% undervalued, according to Simply Wall Street. And this platform does a discounted cash flow analysis. So they forecast out all of AMT's future cash flows for indefinitely in the future, and they discount them back to the current point in time. And right now, when they do that, their true estimated fair value per share is at $303. So right now, that means the company is close to 20% undervalued, trading at the $244 level. So a company that has great operations with great plans for future revenue expansion going forward, that's actually considered undervalued at this current level. And American Tower is a global company with over 187,000 sites all around the world. We can see they have strong operations within North America, South America, Europe, Africa, and India. So the company is globally diversified and spans multiple different networks with various communication needs. And overall, their total revenue, earnings, and cash flow have been growing year over year. We can see total revenue from 2010 to 2020 grew at a CAGR of 15%, which is absolutely incredible, to around $8 billion in the trailing 12 months. Their adjusted EBITDA is growing at 14.4%, once again, a very fast expansion, and their consolidated adjusted funds from operations are growing at 14.8% averaged over the past 10 years as well. So overall, the company's been expanding at a terrific rate, and their average annual dividend growth per share is at greater than 20% over the past 8 years. And if we take a look at that dividend, they have a yield right now of 2%, their annual payout per share is $4.96, and their funds from operations payout ratio is at 53%, which is very low and very sustainable for the real estate industry. And we can see that fast annual dividend growth rate right around 20% over the past 5 years. So although the current yield is low for the real estate industry, AMT also provides investors with great long-term share price appreciation of over 133% in only the past 5 years. So the dividend, along with the share price growth, provides a great total return for AMT shareholders. And if we take a look at some future growth projections, analysts are forecasting 18% annual appreciation add in the 2% dividend, you're looking around a 20% expected total return for the next 5 years in the future. And at this current level, the company is considered a buy, coming in with a 2, and they're sitting below their 12-month expectation of $279 per share. So AMT is one of the fastest growing REITs in the industry. Their total operations continue to grow year over year. They have plans to expand their current site locations as well as more monetization of their existing locations. And I think as a whole, definitely one of the strongest REITs on the market. These cell towers are always going to be in demand as we continue to go 5G and transition into more wireless connectivity. The demand for the locations are going to grow. And I think because they've already been so well diversified globally, it's going to be very hard for any competitors to come in and rebuild what AMT already has in existence. So this was the first specialty REIT that we're going to go over in this episode. And now if we transition into company number 2, it is ticker DLR, which is Digital Realty Trust. They currently trade for around $150 per share, and this company has a market cap at $44 billion with a current dividend yield above 3%. So once again, another specialty REIT that is considered to be undervalued at this current level, trading with a 23.5% discount according to Simply Wall Street, and their estimated fair value per share is at $195. So Digital Realty is a unique REIT on the market. They operate data centers and they're tailored to a fast-growing market. And right now the company has over 4,000 global customers across their 291 different data center locations spread out across North America, South America, and in the international market. And this company operates the data centers that house different service and network equipment for some of the largest software and hardware companies in the tech space. And the actual servers located within these buildings that process and store the data are supplied and owned by their customers. So essentially what Digital Realty does is provide a highly reliable, secure environment with redundant mechanical, cooling, electrical power, and network communication connections so that their customers' servers can run 24/7 without any issues. And if we take a look at Digital Realty's top 20 customers, they have some very impressive names on the list and some of the strongest companies in the world that are not going anywhere anytime soon. Their largest customer is an unnamed Fortune 50 software brand across 53 locations. Then they have IBM, Facebook, and Oracle, 3 major tech players, along with LinkedIn, who's owned by Microsoft, and they also have the leading communication companies in Verizon and AT&T. So they have some massive companies across their platform using different locations spread out all across the world. And their massive customer base is highly diversified. And I think going forward, I'm not worried about any of these big names going out of business or canceling their deals with DLR. And if we take a look at the company's income statement, every single year, their total revenue has been expanding at a fast rate. From around $2.1 billion back in 2016, every single year it's growing to over $4.16 billion in the trailing 12 months. And if we take a look at the chart, continuous upward momentum, which is exactly what we want to see. And if we take a look at their cash flow statement, their quarterly cash flow and their total free cash flow every single year continues to grow, which is exactly what we want from an expanding REIT. And we can see $1 billion of total free cash flow back in 2017, up to $1.3 billion, then $1.5, and now over $1.7 billion of total free cash flow in the trailing 12 months. So they're trending in the right direction. Sales are expanding, cash flow is growing, which is exactly what we want from a REIT in our portfolio. And right now they have a nice yield above 3%. Their funds from operation payout ratio sits at around 71%, which is manageable for the REIT sector, and their 5-year dividend growth rate is at over 5% per year, compounded over the long term. And if we take a look at their investor presentation, their funds from operations payout ratio actually remains stable since 2017, right around the 75 to 80% mark. And their long-term dividend CAGR from 2005 to 2021 is at 10% per year. So this company has been great for investors. Your annual payout continues to grow annually. The company pays you more and more per share over the long term, but they're maintaining a sustainable payout ratio averaging around that 75 to 80%. So over the long term, your payout's going up, but the company's sustainability is staying consistent, which is exactly what we want to see. And if we take a look at going forward, they're forecasted to grow at 31% per year. That'd be incredible. 30% annual expansion in their earnings and their share price would be massive for the company. And right now, they are considered a buy coming in at a 2.1, and the current share price of $149 is still below the 12-month expectation of $161. So definitely another REIT to take a look at for your portfolio that currently trades around $150. They're a unique operator of data centers with some of the largest tech companies in the world using as their top customers. So another well-positioned company to grow over the long term. As we become more of a digital society, the need for data centers and servers is only going to expand as well, and being a trusted name in that industry will lead to nice growth opportunities to expand their current operations. So this was company number 2 in this episode, and now if we move on into REIT number 3, in the final one we're going to go over today, it is ticker PLD, which is Prologis. They currently trade for $114 per share, and over the trailing 12 months, they are up by 29%. They have a market cap at around $87 billion with a nice dividend yield of 2.23%. And this is a logistics REIT that operates different facilities for some of the largest transportation and commerce companies in the world right now. And according to Simply Wall Street, they are also slightly undervalued, like the first 2 names we've already gone over, trading at close to a 4% discount at their current share price. And their estimated fair value per share is at $119. And if we take a look at the company's investor presentation, they have facilities in North America, South America, Europe, and Asia with over 154 billion of assets under management. And overall, they have some of the best customers in the world. Their top 10 customers include Amazon, FedEx, UPS, Home Depot, and DHL. So some of the largest transportation and retailers in the market right now use Prologis for their distribution and the logistics centers. So that's absolutely incredible. And we can see they're diversified across all the different types of products going through their facilities. And they've been performing very well over the longer term as well. And their core funds from operation per share are growing at 10% per year over the past 5 years, outpacing the REIT average and the overall S&P 500. And their dividend CAGR over that same past 5 years is at 9% per year versus the overall REIT average, which only comes in at 2%, and the S&P 500 average of around 5% annually. So I know this company operates facilities all around the world. They have some of the largest companies in the world using them in their top 10 customers, and their total dividend CAGR and their funds from operations have been outpacing the market over the past 5 years. And if we take a look at their income statement, total revenue annually continues to reach record highs with over $4.8 billion of total sales in the past 12 months. And going forward, their cash flow has also been growing as well, and we can see in the trailing 12 months over $3 billion of total free cash flow, and every single year that number continues to climb even higher. So definitely another REIT to take a look at, and at this current point in time, they have a yield of 2.23%. Their payout ratio from their funds from operations is only at 63% overall, and like we saw over the past 5 years, their dividend CAGR is between 8 and 9% annually. And going forward, the company is considered a slight strong buy at this level, coming in at a 1.9, and the current share price of $114 is below the 12-month expectation of $122. So Prologis is definitely another specialty REIT to take a look at right now on the market if you want exposure to the real estate sector, but you don't want to own a traditional shopping mall, warehouse, or apartment style REIT, which you can find hundreds of on the market right now. So now we're going to kind of wrap up the episode. We've gone over 3 different REITs you can take a look at. We took a look at American Tower, Digital Realty, and then Prologis. 3 specialty REITs, all operating business in different fashions. American Tower focused on the cell towers and communication. Digital Realty is the data center REIT. And then of course, number 3 was Prologis, which is the logistics center and distribution center REIT with locations all around the world. So all 3 companies have completely different operations. They've all performed very well over the past 5 years, and they all operate in industries projected to expand rapidly for many years to come and offer their shareholders a lot of upside potential, even after the run-ups they've all seen as of late. And as a whole, I do believe a nicely diversified, well-rounded dividend portfolio should have a small allocation toward the real estate sector. Even if you don't want to go towards the traditional REITs, picking up a few specialty REITs like the ones we discussed today may give some greater diversification and exposure to a market you'd probably never get into with your own investments. So as a whole, we're going to finish the video up here. I want to thank you for watching to the end. Please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.